Top 10 DSCR lender mistakes that cost investors thousands. Let me ask you a question. Would you knowingly pay an extra $10,000, $25,000, or even $100,000 for the exact same investment property? Probably not. But here's the scary part. Thousands of real estate investors do exactly that every single year. Not because they bought the wrong property, not because they overpaid, but because they chose the wrong lender. Here's something most people don't realize. DSCR loans are not standardized. Unlike many conventional mortgages where guidelines are fairly consistent, the DSCR world is much more flexible. Every lender has its own underwriting philosophy, pricing model, reserve requirement, and property guidelines. And if you don't know what questions to ask, you could end up paying significantly more than necessary, or even worse, watching your deal fall apart after you've already spent money on inspections, appraisals, and attorney fees. Today, I'm sharing the top 10 mistakes investors make when choosing a DSCR lender, mistakes I've seen cost investors thousands of dollars, missed opportunities, and months of unnecessary frustration. If you're buying your first rental property or your 15th, this information every investor should know. Let's dive in. Mistake number 1, shopping only for the lowest interest rate. This is by far the biggest mistake. Someone calls 3 lenders. The first says, my rate is 7.25. The second says, I'm at 7.5. The third says, I can do 6.99%. Most investors stop right there. Perfect, I'll take the 6.99. Not so fast, because the interest rate is only one piece of the equation. You also need to understand discount points, origination fees, processing fees, underwriting fees, appraisal costs, prepayment penalties, lender credits, closing timelines. Here's an example. Lender A rate 6.99%, but he's charging 3.5 points. Lender B has a rate of 7.25%, but he's only charging 0.5%. Which loan is cheaper? Many people assume lender A. But if you're paying 3 additional points on a $600,000 loan, that's $18,000 more at closing. Sometimes paying a slightly higher interest rate actually saves you far more money up front. Lesson: always compare the total cost of the loan, not just the advertised rate. Mistake number 2, ignoring prepayment penalties. This one hurts. Imagine you close your loan today. 6 months later, interest rates drop. You decide to refinance. Great idea, until your lender says that'll be a $27,000 prepayment penalty. Wait, what? Many DSCR loans include prepayment penalties. Some are 3 years, 5 years, sometimes even longer, and they can be structured in different ways. For example, 3-2-1, meaning 3% the first year, 2% the second, 1% the third. Or they could be yield, maintenance, or step-down penalties depending on the lender. Now, prepayment penalties aren't automatically bad. In fact, accepting one may get you a lower interest rate. The mistake is not understanding what you agree to. Always ask, if I refinance or sell early, exactly what will it cost me? Mistake number 3, using a lender that doesn't understand your strategy. Let's compare 2 investors. Investor number 1 buys long-term rentals. Investor number 2 buys Airbnb properties. Those are completely different businesses. Yet some investors use lenders that don't even finance short-term rentals, or lenders that calculate Airbnb income differently than expected, or lenders that require 12 months of operating history. The result? Denied. Not because the borrower was weak, because the lender wasn't the right fit. The right lender depends on your strategy. Are you buying long-term rentals, short-term rentals, mixed-use buildings, condotels, rural properties, large multifamilies, portfolio acquisitions? Not every lender specializes in every asset class. Mistake number 4, not asking about reserve requirements. Here's a conversation I have all the time. Investors say, I have enough money to close. I ask, how much is left after closing? Silence. Many investors budget for down payment, closing costs, inspections, attorney, appraisal, but forget reserves. Some lenders require 6 months, 12 months, even 24 months of reserves. If you don't know what's up front, you may discover you're short after you have already spent money on the transaction. That's an expensive surprise. Mistake number 5, assuming every lender calculates DSCR the same way. This is one of the biggest misconceptions in the industry. 2 lenders can look at the exact same property and come up with different calculations. Why? Because they may calculate qualifying income differently. Some lenders use current lease agreements, others rely primarily on the appraiser's market rent analysis. Some have different guidelines for vacant properties or recently renovated units. The lesson: don't assume that because one lender declined your ratio, another lender will reach the same conclusion. Sometimes the lender, not the property, is the issue. Mistake number 6, waiting until you're under contract to talk to a lender. Imagine walking into a car dealership, buying a Ferrari, then asking your bank if they'll finance it. That's how many investors buy real estate. They find a property first, then worry about financing later. The better approach: get pre-qualified, know your budget, know your reserve requirements, know your down payment, know your lender's guidelines. That way, when the right deal appears, you're ready. In competitive markets, speed matters. Mistake number 7, choosing a lender that can't close on time. Here's an expensive lesson. You negotiate an incredible investment property. 30-day closing. Everything is moving smoothly. Then your lender takes 55 days. The seller gets frustrated. The contract expires. Another investor buys the property. You lose inspection fees, attorney fees, appraisal costs, earnest money in some situations, and perhaps the best investment opportunity you found all year. Ask every lender, what is your average closing time for a DSCR loan? Don't accept vague answers. Mistake number 8, not understanding loan pricing adjustments. Many investors think pricing depends only on credit score. It doesn't. Pricing can change based on loan amount, property type, occupancy, loan to value, cash out refinances versus purchase, first-time investor status, credit score, DSCR ratio, loan size, market. Every adjustment affects your final interest rate and closing costs. That's why 2 investors with the same credit score may receive completely different pricing. Mistake number 9, choosing a lender with limited products. What happens when your investing strategy changes? Maybe today you're buying a duplex. Next year, you want a vacation rental, then a mixed-use building, then a portfolio refinance. If your lender only offers one product, you'll be forced to start over each time. A mortgage advisor with access to multiple lenders often has more flexibility to match the loan to the property. Think long-term, not just this one transaction. Mistake number 10, treating your mortgage advisor like an order taker. This is my favorite one. Many investors call and say, I need a DSCR loan. That's like walking into a doctor's office and saying, I need surgery. Maybe you do, maybe you don't. Instead, tell your mortgage advisor, here's my goal, here's my portfolio, here's my exit strategy, here's my timeline. Maybe a DSCR loan is best, maybe a bank statement financing, maybe conventional, maybe commercial financing, maybe a portfolio loan. The right advisor should help you build a financing strategy, not just quote a rate. Before you commit, ask these 3 questions. Question number 1, what is the total cost of this loan, including all lender fees and points? Question number 2, what are the reserve requirements and prepayment penalties? Question number 3, have you closed loans similar to mine? If you're buying an Airbnb, ask about Airbnb experience. If you're buying through an LLC, ask how often they close LLC transactions. Experience matters. Let me give you an example based on a common scenario. An investor buying a $750,000 rental property receives 2 quotes. Lender 1 gives a rate of 6.875 with 3 points. Lender 2 gives a rate of 7.25 with 0 points. The investor almost chose the lower rate, but those 3 points equaled $16,875 due at closing. When we calculate the monthly payment difference, it was only about $180 per month. It would take nearly 8 years just to break even on the upfront costs, and this investor planned to refinance in 2 years. The cheaper rate would have cost them thousands. Always calculate your break-even point. Here's another scenario. An experienced investor bought a vacation rental near the shore. The first lender declined the loan because they didn't like projected short-term rental income. The investor assumed the deal was dead. It wasn't. The problem wasn't the property. It was the lender. A second lender that specialized in vacation rentals had different guidelines, evaluated the property differently, and the loan closed successfully. The lesson: one lender, no, doesn't always mean your deal can't be financed. The biggest mistake investors make isn't choosing the wrong property. It's choosing the wrong financing partner. A good mortgage advisor doesn't simply quote interest rates. They help you structure deals, avoid underwriting surprises, compare lenders, reduce unnecessary costs, protect your long-term investing strategy. Remember, you're not just financing one property. You're building a portfolio. Every financing decision affects what you can buy next. Think beyond today's closing. Think about where you want to be 5 or 10 years from now. If you found this video valuable, hit the like button and subscribe, because every week I create detailed videos on mortgages, investment financing, credit strategies, and real estate investing that help you make smarter financial decisions. If you're looking at a rental property and want to know which financing options make the most sense, reach out to me before you sign the contract. My team works with multiple DSCR guidelines, and because every loan is different, we can compare programs to help you avoid costly mistakes and choose the loan that best fits your investment strategy. And now I want to hear from you. What's the biggest challenge you're facing getting finance for an investment property? Leave a comment below. I personally read them, answer as many as I can, and many of the future videos come directly from your questions. Thanks for watching, and I'll see you in the next video.